Good afternoon, everyone. Welcome and thank you for attending our Investment Currents live event, our second call this year. I am Chris Briscoe, Vice President and Wealth Advisor for Girard, and joining me, as always, is Girard's Chief Investment Officer, Tim Chubb. We have a great call lined up for you today, but before we begin, we do have our usual housekeeping items. First, you will see some disclosures on the screen regarding forward-looking statements and how we reference Girard, so please take a minute to read through. While you're reading, I also want to make you aware that this presentation is being recorded. So again, if you're not able to stay on for the duration of the call, or you want to rewatch this again in the future, please go to our website, which is meetgirard.com. The replay of this presentation will be available within the week, but while you're waiting, there's plenty of additional information on the site that you may find interesting and helpful. Also, as in past calls, we welcome you to send in any questions you may have. You will see in the bottom right-hand corner of your WebEx window, the Q&A section. All you have to do is click on Q&A, and that'll allow you to enter your question, submit it, and then at the end of the presentation, we'll address as many as we can. Speaking of questions, we do have a couple questions that we would like to poll the audience. So we'll start with that. And the first question is, are you familiar with the Black Diamond online portal and mobile app? A, yes, I use it. B, yes, I'm aware, but need to get signed up. C, I was not aware. And D, I am not interested. So go ahead and answer that when you get a chance.
Yeah, hi, Chris. Just made a quick comment about the Black Diamond online portal and mobile app. Really a wonderful tool. If you're not familiar with it, that we utilize here, it's really the system that we use for portfolio accounting and performance reporting. And so all of your client statements are being generated from the Black Diamond portal. If you're a client of our registered investment advisor, Girard Advisory Services, we're working with some of the other lines of business across our organization. You can access through our website, meetgirard.com. Top right, you'll see Black Diamond, and that would be the portal. And you can access your statements digitally, as well as a lot of other information related to your portfolio and the way that your statements are formatted. And then if you go to the App Store and just search Girard, you'll also find it, I think, in both the Android and the Apple iPhone App Store. So it's the same login, and just need to get set up with your team.
And the results are in, and 37% of you do use it. 42% they're not aware of it. So that's good to have, and we'll make sure that our advisors are reaching out to you so you can get set up on the Black Diamond portal. Second question is, what are your thoughts on in-person meetings with your advisor? A, looking forward to meeting face-to-face. B, will be comfortable once vaccinated. Or C, not yet comfortable with in-person meetings. And Tim, you and I were talking about this earlier this week with, I had a little debacle with the Johnson & Johnson vaccine, but was able to get my first shot from another one of the vaccines. So I'm looking forward to getting my second in the beginning of May, and then getting out there, and depending on the results of the poll, we'll decide how much we are getting out.
Yeah, I'm excited. I'll get my second one next Wednesday. So light at the end of the tunnel. I think most of our senior leadership team's now vaccinated, so we're making some good progress here.
All right, the poll has ended. See what the results are. All right,
we're getting out on the road.
54%. Looking forward. Good. So that makes me, I'm a little less nervous now. I'm happy to get out there. Like I said, once I'm fully vaccinated, I'll be comfortable and make sure that I can get out and see as many clients as I can. All right. That's over, so let's begin. Tim, happy spring. Good seeing you. Once again, we're in the office together. It's great to see you warm weather's here, and dare I say, and you said it earlier, maybe we're getting back to normal, but before we, spring forward, I think we should take a look at the previous quarter and get a recap on your thoughts about the market and the economy.
Sounds great. Yeah, and thanks everybody for joining us. Again, I'm Tim Chubb, our Chief Investment Officer here at Girard, and I'm glad that you can make our second economic and market update for the year. As Chris mentioned, spring is here in the Philadelphia suburbs. It's been really nice to see our cherry tree bloom in our yard. That was really the official start of spring, at least in our household. So things are definitely starting to feel a little bit more normal. It's good to see, I think, a lot of you getting your vaccine or at least feel comfortable visiting with us. And we've definitely seen an uptick of face-to-face meetings. I think it'll be good, as we always prefer, really to meet you in the way that you'd like, getting together face-to-face and get back out and travel with you all. We've been really appreciative of all the time that you've spent with us during the last year during these market updates. And we really hope that it's brought you a lot of valuable insight into how our research team has been looking at the economy and the markets. And we're constantly trying to improve this format. And so we've gotten some wonderful feedback from some of you. We've gotten some really good constructive criticism about how these can be improved. And so please feel free to reach out to either myself or Chris, your advisor, your point of contact here at the firm. Let them know that what's working, what's not working. We want to make sure this is a valuable use of your time on a sunny Thursday afternoon. So as Chris mentioned, our plan is to really update you on the last 3 months of the market moves, as well as answer some of your questions and concerns related to inflation and tax reform. And then we'll get into some Q&A questions, as always, towards the end. So feel free to ask if you can answer them if you'd like, but feel free to ask some questions in the Q&A box on the bottom right of the WebEx application, and we'll definitely look forward to getting to some of those soon. So let's start with recapping the performance in the markets for the quarter before we dive into the rest of the update. Here in the U.S., the S&P 500 finished the quarter with a 6.2% gain, bringing its 12-month performance up to just over 56%. And so remember, the market bottomed last year on March 23rd. And so the 12-month figures are going to be really eye-popping, as the base of last year was near the market lows. U.S. small cap stocks, as measured by the Russell 2000, rose 12.7% in the last 3 months and gained almost 100% in the last 12, up about 95%. Overseas, indices for international stocks, as measured by the MSCI EAFE, which stands for Europe, Australasia, and the Far East. I guess it's a fancy word for saying Japan, Australia, and New Zealand, as well as the MSCI Emerging Markets Index, rose 3.6 and 2.3% respectively, with a full year gain of just over 45% for the MSCI EAFE and almost a 60% gain for the MSCI Emerging Markets Index. On the other side of the portfolio, the bond market sold off in the last 3 months as investors attempted to price in their expectations for higher rates of growth and inflation. The Bloomberg Barclays Aggregate Bond Index fell 3.4% for the first quarter, but still maintains a gain of being up 0.7% in the last 12 months. And the benchmark 10-year Treasury closed the year with a yield of 0.93 or 0.9%, and that has shot up to 1.74% at the end of the quarter. Short-term rates like the 2-year Treasury remain stable at 16 basis points, or just short of 0.2%, and rose just 3 basis points over the course of the quarter. And then lastly, the 30-year Treasury yield started the year at 1.6%, but ended the first quarter at 2.4%. And yields move inversely to prices. So as we've seen a sell-off in the bond market, yields have been moving higher, prices lower, to make those yields move up a little bit.
And Tim, the market is always worried about something, right? And it seems like investors have shifted their focus from the vaccine rollout and COVID-19 data to the good news is bad news situation we discussed last quarter, right? And that growth is accelerating, and so too might inflation. What are your thoughts on inflation right now, and is it something we should be concerned about?
Sure. Yeah, Chris, that's absolutely right. Our concern towards the end of last year was how quickly vaccine distribution will look, and essentially will dictate the trajectory of the economy this year. But Recent economic data has really shown signs that the U.S. is recovering more quickly from the pandemic than many investors had expected, and showing up all over the place. Data points from the Purchasing Managers Index to the labor market, everything has been inflecting higher, and I think more quickly than a lot of investors had anticipated. And I think during the last call, I had mentioned that this was something that we had been expecting this year, and more so expecting it to take place sometime in the summer. Maybe the May, June time frame, as opposed to February, March, and April, as we've seen so far this year. And so as expectations have increased, inflation's certainly been a worry for investors, and I think sensationalized a bit within the media. But I'm afraid both the investors and the media are really confusing reflation with inflation. And so before we dive into inflation a bit more, just a couple quick data points to illustrate just the scale and size of the economic recovery here, at least in the United States. We saw in March a really strong ISM manufacturing index number of 64.7, far surpassing expectations of 61.5. And this is actually a 37-year record high, and obviously a reflection of robust manufacturing activity picking back up, really strong orders in production and employment, as well as increases in prices paid for inputs. And so we certainly, if you are looking to get some home renovations done, lumber prices have been skyrocketing. And so, prices paid for inputs has definitely been going up as well. Services index actually had a really strong March as well. It had been lagging manufacturing a little bit, which was surprising, coming in at 63.7, which was up 8.4% for February, with all 11 industries exhibiting growth. In March, the Federal Reserve revised their U.S. GDP growth forecast to 6.5%, and the unemployment rate by year end to 4.2. We're currently at 6% on unemployment, and it's actually a little bit higher than that due to how many Americans had actually left the labor market over the course of the last 12 months and sort of came out of that number. And so while 6% is definitely a step in the right direction, it's down from 15.7% last year. I'd say it's a little lower than what probably is reality when you think about how many Americans had left the labor market just discouraged. And so we expect services and manufacturing activity to remain elevated throughout the rest of the year. There's a tremendous amount of pent-up demand, of course, stimulus checks, and plenty of increased optimism now that vaccines are being distributed. And one of the things that's interesting, which is, I think, driving this inflation and also, the economic recovery, has been personal savings rate. Many Americans, were fortunate where they elected to delay spending, obviously to the detriment of the U.S. economy last year, especially in the first and second quarter. And while savings has declined recently to about 20.5%, it still stands close to historic highs and will be inflecting again higher as some of this last round of stimulus checks start to make their way through the economic data. And with more businesses reopening, new stimulus checks from the new Biden administration, $1.9 trillion stimulus bill, we think this pent-up demand and higher level of savings will really fuel the economic recovery, even beyond the projections from the Federal Reserve this year being a bit above 6%. And so, I wouldn't be surprised if we saw GDP get closer to 7 or even past it this year. And nonetheless, that all needs to be priced into the market. With all the pent-up demand, it's also important to note that the global supply chain is still operating in a global pandemic. We've seen commodities jump higher, and of course, the delay in the Suez Canal last month didn't really help things either. But really, it's a supply issue to a large degree. We've seen a massive supply shortage of computer chips, semiconductors, impacting everything from mobile phones. Apple has come out recently and said that they're going to be delayed. GM has come out and said that they will be delayed in delivering cars as well, since they cannot obtain the chips required to input into those products. And so a bit of a delay has been certainly taking place as a result of the amount of demand, but also the supply chain still reeling from the global pandemic. And so, although we've seen, certainly there's been plenty of cases in the media, talking about lumber prices, I mentioned, inflation pressures have really remained subdued so far. And so we think that the global supply chain will respond to demand, meeting with more supply as more restrictions are lifted, and in turn, that will normalize prices. And so while I think we could see inflation get close to 2.5% this summer, one metric that the Fed looks at is PCE, or personal consumption expenditures, which has a larger allocation to healthcare than CPI. I think it'll move past 2% this year and closer to 2.5% this summer. But I think it settles back down as we get closer to entering the 2022 and beyond, as again, the global supply chain is able to catch up with demand that's taking place. And so this seems to be the scenario that the Fed is also projecting, and they will be able to stay the course and exiting very gradually from their highly accommodative monetary policy decisions, both in quantitative easing and the bond buying, as well as the short-term rates. And so I think as far as bond buying is concerned, the FOMC will likely start socializing tapering later this year for early 2022. It could be sooner, depending upon how the labor market responds this summer, and then similarly discuss raising rates sometime in 2023, with the expectation that rates will begin rising once again in 2024, of course, a ways away, and certainly a lot can happen between now and then. But I think the Fed, could be underestimating the amount of stimulus and how quickly the labor market may bounce back. I might have mentioned on the last call, my view was that as the unemployment rate got closer to 5%, that I thought the Fed would begin socializing tapering. But I suppose it will be one of those good news is bad news situations, as you mentioned. And the Fed has said time and time again, Jerome Powell and other governors have said that it's really important to have a clean handoff from supporting the economy from a stimulus perspective to seeing the real economy support itself, like I think it'll be able to do much better next year. And so last thing I'd like to share is inflation is extremely, extremely difficult to generate on a permanent basis. I know a lot of you on the call are probably very sensitive to higher rates of inflation that were caused back in the late 70s and early 80s. But the last 10 years are really a prime example of, despite all the quantitative easing, all of the bond buying, all of the massively stimulative measures, especially in monetary policy from the Federal Reserve, that the Fed was really not concerned very often over the last 10, 11, even 12 years about raising rates, because inflation was so well in check. And so when you look at underlying basket of goods that are being priced for CPI and PCE, about 40% of it is what we would consider more cyclical, and 60% is acyclical. So acyclical prices like healthcare really have not grown in a meaningful way, at least here in the short term. And we don't expect to see significant price increases within this broader section of more of the acyclical basket. But the 40%, the cyclical section, is really where we're seeing prices jump. I mentioned lumber. I'm sure you're probably groaning, as I've said it 3 times now, if you're getting some house projects done. But I think the market, again, or at least the media, are expecting inflation to sort of remain elevated forever, and us to see this more normalized inflation environment. But the break-even inflation pricing within the bond market, language from the Fed, and other moves within the bond market just aren't suggesting a massive inflationary event to really be the base case scenario.
Yeah, and pulling the string a little bit more, the expectations for better growth this year and therefore inflation really came through last quarter, right? We saw markets at all-time highs, but under the surface, we saw a fair amount of volatility, especially in the growth names. The bond market also sold off, as you mentioned. Treasury yields rose, and the benchmark indices slid. Why did higher growth and inflation expectations cause these areas of the markets to struggle?
Yeah, great question. And I think it's really an important one. And I'm not just picking on the media today, I swear, but it's really an important fundamental concept that it really isn't discussed that much in the financial media and press, where we're linking the economy, the real economy, with the bond market, and then in turn how the real economy and the bond market drives stocks. And really that's the order in which things sort of flow. Is the real economy, at least the expectations, will change. That'll be reflected within the bond market. Sometimes the media refers to the bond market as the smart money, and certainly less volatile than the stock market. And then that in turn typically drives the stock market. And so it's really important to see these linkages. So it'll be probably a longer answer, but I think it's important to start with the bond market, since we just talked about the economy. And so the bond repricing, the sell-off that we've seen this quarter, at its heart was really mainly a reflection of the progress in the economic recovery. Like you said, towards the end of 2020, we were concerned about vaccine rollout, but the economy was coming out of this big hole that we saw in the first and second quarter. Vaccine announcements led the market to upgrade its growth expectations sharply towards the end of last year, especially after December 4th, when we got the good news about the vaccine as well as the therapy. And bond yields really didn't move. We didn't see it really move in the bond market as a lot of the stock market was repricing some of these higher growth expectations. And with the Fed anchoring short-term rates and really a deeply distressed starting point of the economy, that sort of kept a lid on yields even as growth has started to improve over the last couple of months. But as the vaccine progress really moved the economy closer to the point of substantial, growth acceleration, it created this dry, tinder for the bond market to finally start reflecting these growth and inflation pressures. And so the spark that I think lightly lit the tender was really the massive fiscal stimulus that was passed in December, and even more so in March, which, unlike earlier rounds of stimulus, hasn't been implemented in the face of an immediate emergency like it was last year, but rather an emerging economic recovery. And so, the level of stimulus at the point in which we were sort of coming out of this economic trough was really important, which ultimately, again, lit that tinder related to the bond market. And so investors basically looked and said, taking all that in consideration, we basically left the bond market alone. We've repriced the growth outlook in many other places. And now we see a more predictable, sort of recovery profile that demands yields need to be higher. And so as economic activity improved and we started to see, really a lot of Americans getting vaccinated, I think it'll be something close to 50% of Americans will be vaccinated by the end of May. Investors need to price this in the bond market and do it quickly. And so an important concept is as growth accelerates, rates follow, benchmark rates rise. And investors are not going to be comfortable owning bonds issued or priced when yields were lower. And so it's sort of this concept, and pick any company. Take Apple, for example, which I own, and we recommend as a firm for disclosure purposes. Let's say they borrow money for 10 years at 3.5% per year, and so that's a coupon that they're going to pay you, typically semi-annually at 3.5%. And if rates were to move up a quarter of a point, new debt would be issued at 3.75%. And if it's the same credit quality, the question is, who would want the old bond that yields 3.5%? And the answer is nobody. We're investing to make money. And so as a result, the bond market will reprice that bond, sell it off. And so that between today and the date that bond matures, the total return, that's the coupon plus the price moving back to par, which was the original amount of money that was lent, would ultimately yield the same amount, 3.75%, that new bonds are being issued at. And so this is essentially what happened. I think I meant, earlier on we talked about the AG, which is sort of the S&P for the taxable bond market and treasuries, selling off about 3.4%. And so as a result of sort of that phenomenon, we saw the bond market reprice. And so maybe for most of you, I think on the call, you're more interested in the stock side of things. And so your question might be, so how does that impact stocks? I really think it's two reasons. One, some companies simply benefit more so than others when economic activity is increasing. And so an improving economy helps demand for commodities like oil. So energy has been the best performing sector so far this year. Really, as a financial or a bank, which makes money from borrowing at low rates and lending them out at higher, bank stocks have been certainly benefiting from a steeper yield curve. And other sectors like industrials and materials also benefit from higher rates of consumption as well. And so during the good times, the stable earners, the growers like healthcare, utilities, consumer staples, they tend to struggle. As with last year, the gains tend to be uneven, with some groups of stocks doing better than others. The winners of last year have lagged this year. The losers of last year have outperformed so far this year. And so while some of this reversal is to be expected in any market environment, I think there's some questions about whether anything has to do with rising rates or potentially this was just these companies were sort of forgotten in the last run-up. And many of these companies that were most impacted by the economy shutting down really were mispriced and undervalued. And so the last thing I mentioned is borrowing costs. And so sectors that are really relying upon borrowing costs to grow, technology companies, real estate, utilities, and the like, they're impacted because borrowing costs, to make acquisitions or reinvest back in their business are also going up. And on a relative basis, equities, I think, despite inflation being a concern, ultimately is really a good place to actually hedge yourself from higher inflation to some degree, while bonds are expected to suffer a bit more in an inflationary environment. So I don't want this to turn into you calling your contact here and trying to jump out of bonds. because of this explanation. But I think the point is the bond market's really already priced this in already, so it's sort of the horse has left the barn. At least as far as, we think that pricing in the growth and inflation worries. And so I suspect the worst is over. I don't think the 10-year will necessarily get past 2% very, very much this year. Maybe we'll move a bit higher next year, but relatively stay within that range. And I think that as a result, a lot of the moves in the bond market rather are over. And I'd say, of course, you've hired us for a reason. We were well prepared for this if you're a client of ours who owns fixed income. And so we expected this to occur at some point this year. And there's been other things we've done with our client portfolios to incorporate some hedges in there to outperform, let's say the ag, which has a ton of treasury exposure, so far this year.
Yeah, and that's a good part to shift gears and move away from fixed income overall, at least within the portfolio. Yeah. But I know recently the investment committee has been discussing, potential tax reform, and our clients have certainly been concerned about this possibility. The Biden administration, they've rolled out massive fiscal policy support for economic recovery, and it's natural to expect that at some point Congress is going to attempt to address this fiscal deficit. But how concerned are you about tax reform and the impact it may have on the markets?
Yeah, my favorite question. That's tongue in cheek. But to your point, U.S. deficit and debt levels, as we all know, are certainly elevated. And before I guess share some more detailed thoughts, I think the most crucial point is really to consider, just how narrow the margin of victory was for Democrats in the last election. And we have to take the good with the bad. And so, as long as net, and you look at all the dollars that have been spent and printed and helping to stimulate the economy this year, I think ultimately, despite tax reform likely coming through over the next 2 years, net, we've seen a massive positive to keep our economy on life support. And made this possible, this economic rebound rather possible to happen so quickly and swiftly, which I think is a lot better than the alternative, which is a financial crisis, which I know, as we've mentioned before, certainly would have been more costly in the long run. And I think was really the alternative to what we've seen the last 12 months and how they've transpired. And so, I think that's important perspective to have. I think the Democrats are currently have the narrowest House majority since 1919, which is especially shocking since Democrats reclaimed the White House. And there were, as many as 3 times as many House Republicans that retired than Democrats last year, and so left a lot of seats open without an incumbent. And so Senate was a perfect 50-50 split, which went to the vice president. So you might be asking yourself, why does this matter? I think, the most important thing is everyone needs to take a step back and think about how politically divisive tax reform can be. And given the narrow margin of victory, I think the Democrats will know this and tread carefully for fear of either losing the House and Senate when the midterm elections come around. And November 8th, 2022 will be here before we know it, unfortunately. So with this narrow margin of control, I think it could take a long time for Democrats to get enough support for tax reform, even when using the reconciliation process that requires no participation from Republicans. The final bills, I think, will look very different from our assumptions, or rather what has been detailed so far from President Biden, and as well as Biden over the course of the campaign season, once Congress really starts drafting and negotiating a lot of this legislature. And so I think there's some centrist Democrats that have already suggested the next round of fiscal legislation should be paid for. Treasury Secretary and former Federal Reserve Chairwoman Janet Yellen has indicated that she thinks that at least a portion of the cost should be offset. And so tax increases, always politically risky. But unfortunately for Republicans, they did not reap the political gains, I guess, from 2017 tax cuts, as we've seen in polling that voters were surprisingly uninterested in tax reform, and obviously lost their House majority as well as the White House. And so I think President Biden is likely to spend far more on climate infrastructure initiatives than Republicans want. And the only way to reduce the net cost would be through tax increases that Republicans are likely apt to oppose. And so congressional Democrats will probably, again, use that budget reconciliation process to pass some or all of the next package. In the Senate, reconciliation bills cannot increase the deficit after 10 years, and so any permanent spending programs will require permanent tax increases or spending cuts elsewhere to cover the cost. And so if you're a fiscal conservative, that's kind of good news in that we just can't have this runaway spending. It needs to be paid for, so to some degree, at least by Senate rules. And so even with all that said, I think it'll take years to spend this sort of some of these legislation all out. And by contrast, some of these one-time increases in near-term spending could increase the deficit over the next 10 years if they even pass through reconciliation. So a lot to take in there. It's a bit inside baseball. I'm not a political strategist. I follow it, unfortunately, as much as I have to, which is quite a bit being in my position. But, we think that Democrats will really focus on increasing corporate and capital gains tax rates to offset the cost of the next bill. President Biden has talked to the American public and also in media interviews, proposing to raise the corporate tax rate from 21 to 28%. But I think really an increase, somewhere in the 24 to 25% range is likely all that we'll be able to get through in Congress. During the campaign, at the time, President-elect Biden proposed to raise the tax on long-term capital gains from 20% to ordinary income tax rates, which is similar to an IRA distribution. And for those earning over $1 million, and for taxing unrealized capital gains at death. And so, personally, I think it's going to be extremely difficult to pass some of that, and likely be significantly watered down when it comes to capital gains rates being altered too much. And so, one thing just to keep in mind is the Congressional Budget Office, the CBO, has estimated that each 2% increase in capital gains generates about $75 billion over 10 years. And so raising the rate to 28% may bring in about $300 billion or so. Personal tax rates may also rise, but unlikely to produce the net revenue for infrastructure. During the presidential campaign season, Biden had proposed to restore tax rates before the Tax Cut and Jobs Act of 17 on income over $400,000. I think that's probably likely to take place, and we'll likely see higher earners getting taxed, and that really be more of a focus than I think more so on the income side of things than potentially capital gains, but that's my personal opinion. I think we probably see a partial restoration or full restoration of the SALT deduction, the state and local tax SALT deduction, extending the really generous tax credit that we had in the last COVID relief bill. I can see that getting extended. And so I think while individual tax increases are likely, I think they're unlikely to really move the needle too much for the infrastructure spending. And so the rest of it comes from corporate taxes. And, this would obviously be impactful to the market, something that I'm worried about. I don't think it's been priced in at all yet. When you look at, back in 2017 and Tax Cuts and Jobs Act, of 2017, sectors like technology and healthcare really were the outperforming sectors given their tax rates. And so we haven't started to see the market really price this into the market, or these sectors very much. And so when we look at the numbers and what we, can only go off as speculation at this point, I suppose, I think if you just were to look at, tax reform in isolation in the exaggerated numbers in which are unlikely to come to fruition, that would likely decline, S&P earnings for 2022 by about 8 to 9%. But that's before we start adding back the benefits of an infrastructure bill. That's before we start adding back the benefits from really the U.S. consumer being in as strong of a footing that they are. And so you have to look at the entire picture and not just tax reform being bad. And how much has all that stimulus and how much will an infrastructure bill really contribute in a positive way to corporate earnings? And so I think when you take that all into account, we're looking at probably somewhere between 2 and 4% decline for S&P 500 type earnings next year, which again will require some repricing within the market. And of course, it'll impact all companies immediately, whereas an infrastructure bill would be, rolled out over time and take some time to be distributed. But ultimately, I think there's a lot of good in what's been passed as far as policy has been concerned recently to help our economy, or country rather, keep up with the global economy. And if you believe in these, growth multipliers, it's a bit of an economist term, but it's even a smaller hit to corporate profits, and especially when you look at looking at a 2015 CBO report showing the highest growth multipliers from federal government purchases of goods and services are actually found in Biden's infrastructure bill. And so, in other words, all this money could be well spent to help grow the economy. and taking a bite out of the earnings the earnings hit from tax reform. So bottom line, I guess like it or not, tax reform's coming. I think the good news is the stimulus last year, the benefit from the infrastructure bill, I think will largely offset most of the negative as it relates to the S&P 500 earnings, and net, the policy actions from the previous several years, I think has been a very much a positive for corporate earnings and the economy, in my view, and absolutely necessary given just how dire the alternative consequence really was. So,
yeah, with everything, all that you've discussed, it's all the more reason to make sure your portfolio is properly allocated and make sure you either create a financial plan or update your current financial plan to sort of stay ahead of it as much as you can.
Absolutely.
All right, well, we're going to move on to questions now, and it just so happens we have one more poll question, and it ties in with the first question we have submitted as well. So I'll ask the poll question first, and then we'll get into it, but it has to do with cryptocurrency, and that is, what are your thoughts on cryptocurrency and/or digital assets?
Yeah.
A, interested in learning more and considering investing. B, curious, but probably won't invest. C, not interested. And D, what's cryptocurrency?
Busy week for crypto, I suppose, with the offering yesterday of a company called Coinbase that focuses on custody and brokerage services, excuse me. I do not own Coinbase for disclosure. It's not something we've been recommending to clients unnecessarily, but it's been a busy week as a result of that offering, that direct offering. I think we saw yesterday with the price moves, the benefits of a traditional IPO process as opposed to a direct offering take place. Direct offerings, for those of you who don't know, are when basically the market just, the company just releases all shares that are going to be available all at once to everyone at once, as opposed to IPOs where you submit interest and secure shares before trading. So a lot of volatility.
All right, let's see what the results are. And then I'll ask the first question, which is actually something that you and I talked about before the call and have talked about this week. Especially, I've had a lot of clients as well asking about it in general. Overwhelmingly, 52% interested in learning about it, 24% curious, 14% not interested. No one asked what cryptocurrency was. First question,
let's start there, I think.
That's what I was going to say.
Yeah.
Let's start there just for an overview, just in case if somebody didn't want to answer that. But, what is cryptocurrency? Yep,
absolutely. And I think it's, even more helpful to start with what ultimately drives, a cryptocurrency or a digital asset. And I think when you hear, Bitcoin discussed within the media, a lot of the applications and a lot of the, goals that some investors have for Bitcoin, I think are ultimately, can be achieved through the blockchain technology. And so a lot of times when you hear Bitcoin, I think you can replace it with blockchain and be a bit more broad, because I don't necessarily think that Bitcoin is the end all be all. And so I know we got this question at some point last year, and my response was, with regard to investing, you have to look at your personal situation and make a determination of, is there a greater risk of having 0% of your assets invested in crypto, or say 5%, and meaning 5% you would not be able to say sleep at night given all the volatility that crypto assets typically have had over the years, and 0% would insinuate that you feel similarly to me, and as I'll get through my explanation about blockchain, and that there's an opportunity there and you really don't want to miss out. And so it is still very much in the early innings. So I guess, getting back to just what blockchain is, it's a type of ledger. And so, what are ledgers? They're distributed ledgers have been central to accounting and building business trusts since ancient times, right? They've gone from clay ledgers to paper ledgers to digital record keeping methods. But the concept of recording and storing, obviously, has been something that's been around since the early days, well before pen and paper. And so really it hasn't changed very much until blockchain ledger distribution was really realized. And so back in 2008, just to take a trip down memory lane, Satoshi Nakamoto, which is a pseudonym, wrote and published this famous white paper called Bitcoin, peer-to-peer electronic cash system, I believe it was called. And so Satoshi Nakamoto, who no one really knows who he or she may be, had pointed to cryptography as the answer for us to really fix the issues of trust raised by the financial crisis. And so what he had said, or assuming it is a he, is really what we need as a society is this electronic payment system based upon cryptographic proof that instead of trust, that'll allow really any two parties to willingly transact directly with one another without the need of a trusted third party. And so, to be clear, these distributed ledgers, the blockchain technology that backs these crypto assets, and blockchain are not all one and the same. Blockchain is a type of digital ledger, and with the blockchain form of a DLT or distributed ledger technology, an organization's ledger is distributed or shared across a wide network of devices or nodes, and each node possesses exactly the same information. So everybody knows what's going on as far as like ownership of an asset would be concerned, for example. So it's completely open source. And so every ledger transaction is added to this chain, blockchain, right? And authenticated, thereby creating this audit trail that's very transparent and very traceable, and acceptable and accessible to all. And so transactions can't be modified for the most part, unless the blockchain is really not a good one, in which it can be forked, where an old recent block could be replaced. And really the most important thing about DLT, again, distributed ledger technology, is that it's decentralized. And so not one person or entity controls the data. So there's no central authority to trust. You can just trust the code. And as a result, getting a lot of security from that, because the code itself is able to validate these transactions. And so, a good application or example would be, buying a home or selling a home. You have to pay for this expensive thing called title insurance, which says that the person that's buying it from you has the money, it's in escrow, everything's good, it's U.S. dollars, and hasn't been, created out of thin air. And then you own the home. And then there's no liens against it and everything like that. And so escrow, make sure those two things are I guess in good shape. And then once that's the case, the transaction takes place. Well, with a distributed ledger, you really don't need title insurance, because you would have this ledger that would say that Tim and my wife Amber, we own our home, and the person on the other side has the cash that is necessary to buy it, and the financing through the bank. And so distributed ledger technology can completely take away, I think, an industry like title insurance. And so really tons of applications for this. In 2015, so I guess getting back to the two applications, really, one is what they consider store of value. And I think that's ultimately the destiny for Bitcoin, it really becoming this digital gold. There's only 22 million Bitcoins in existence. No more can be recreated. It's set that way with the code, and it is what it is. And so when an asset is scarce and people want to own a scarce asset for, say, store of value purposes, Bitcoin, I think, serves a purpose very similarly to where gold does. I'm not a huge fan of gold, and therefore I'm not a huge fan of Bitcoin. But I think the other application is really the most exciting one, and that's for payments. And I think that white paper that Satoshi Nakamoto got it into is really diving into a lot of the payment side of things. And in my opinion, the Bitcoin blockchain, the protocol is really not efficient. It's too costly. Really for payments to take place on the protocol. And so Ethereum was launched back in 2015, and we've seen lots of other protocols that have been created over the years that I think will be much more efficient for payments. But the key things are decentralization, efficiency, open source. I think the dream of having Bitcoin be this, sort of utilitarian single currency in the global economy is not going to happen in the way that some have speculated. And but I ultimately think that this is going to be very important, and ultimately it will impact our lives more and more as this technology is being rolled out. And so I guess in summary, I sort of liken it to how mobile phones have evolved over the years, sort of that pre-iPhone BlackBerry day when you had to worry about like SMS text messages and 10 cents, I believe that is what they cost. And, you had roaming charges and all that sort of stuff. And so, while Mark Cuban has talked about this being like the internet 2.0, I think it's probably a little bit closer to, this being really, pre-BlackBerry days and really seeing a lot of efficiency take place within the payments infrastructure within, our global digital finance and economy.
Yeah, and the question specifically that was asked is what do you see in the short and long term for crypto specifically and for blockchain in general? And I guess that's what we were talking about as far as, when I hear Bitcoin, cryptocurrency, I think regulation. So what are your thoughts overall, in next year, next couple of years as far as regulation, taxation, and the like?
Yeah, a lot to unpack there. I think from a regulation standpoint, it's been obvious that I think a lot of regulators had just hoped this would go away. And it's unusual because, the Federal Reserve has been working on a central bank digital currency and researching it, basically a digital dollar going back to 2016. And it's expected that in July of this year, the Federal Reserve Bank of Boston has been working with MIT in trying to find some solutions related to the CBDC, the central bank digital currency. And so I'm really excited to see what their findings were and how that could apply to a digital dollar. In China, the Chinese yuan now has a digital dollar, and there's other countries in the Caribbean that have already implemented such a thing to help with their banking system. And so I think regulation definitely takes place this year, or at least, the conversation begins and figure out just how do we want to treat these things? Because I think the more time that goes by, the more, the snowball just continues to build. And so while originally it was really Bitcoin and Ethereum came in 2015, now we have these NFTs, these non-fungible tokens where people are basically digitizing artwork and tokenizing artwork and selling it for insane prices. And so, how does that get taxed? There's a lot of confusion, I think, about crypto assets and digital assets in general. And one of them is just, if you were to use, let's say, Bitcoin to purchase something like a car, how would that work? And so, in the particular company, it's decided to buy a bunch of Bitcoin, like they're going to give change for a car, which never happens. They ultimately, if someone were to, let's say, buy a car with Bitcoin, whatever they purchased it for, so let's say you paid $10,000 for that Bitcoin, it's now worth, 65, and the car is worth 65. That $55,000 difference between what you paid and what it's worth now would be taxed at ordinary income. So it's not currently considered an asset, like a security, like a stock or a bond. It's also not considered a currency in the eyes of the IRS. And so that's a huge hurdle that needs to be overcome. And ultimately, I think regulation this year could create a lot of volatility within the crypto markets, which could be a great buying opportunity potentially, because I think it will be a sign that, Congress and the global economy is really to take a step forward in embracing this sort of thing. I personally think that, again, Bitcoin is nothing more than digital gold. I don't think it's a protocol that people will build anything on instead of using Ethereum or other protocols out there. And ultimately, I think we'll start to see more and more, in the way of payments. Visa, MasterCard, again, companies I don't personally own, but we have recommended to clients and are recommending to clients, have been focused very intently on how digital dollar and how they would roll such a thing out. And so I think there's a lot more going on behind the scenes, and the media's really talked about. The big story in financial news has been all about just Bitcoin going up and up and up. The bigger story, I think, is payments, and not a lot of conversation's been had around that. So I know you had a couple parts to your question, but hopefully I answered at least a couple of your questions that you got.
Yeah, and that's actually the only question that was asked. So we're actually, unless you have anything else to add, we can wrap up the call today. I'll wait, a couple more seconds to see if a question comes in. But we certainly do appreciate all the you all taking the time. Actually, here comes one. Will there be any fallout from GameStop?
GameStop was what really, I think, kickstarted my research in crypto and blockchain technology even more, to be honest. And what we saw those 2 weeks were really within the financial system, some of the plumbing related to settlement of trades start to get clogged. And part of that was due to a lot of the speculators were using options, but there's this concept, within our industry called T+2. And so if you buy a stock or you sell a stock, it takes 2 days to settle. So today's Thursday. If I were to sell something today before 4, and then it would take Friday and then Monday to finally settle. And so those settlement issues were really causing a lot of problems within the financial plumbing. And so I think it's really a perfect application, for blockchain technology, where settlement could be done over a distributed ledger. And your ownership would be sort of tokenized, or at least use blockchain technology to help make sure that everybody is accounted for as far as who owns it and what period of time. There's a story out there. I'll make it a blog post about Dole Banana. I think that was the company. They were doing a corporate action where everybody had to vote, and they send all the stuff out to their investors, shareholders. They come back with all of the votes, and they count them all up, and they go, "Oh my goodness, we have more votes than shareholders." And it was because of settlement issues that existed because, on a certain day, more than one person, I suppose, could own the share. And because of how settlement works in the financial plumbing, it really was creating some issues for Dole. And so I don't think, as far as fallout is concerned, I think there'll probably be some regulation. I mean, there are some elements to that sort of meme stock mania at the end of January that I think will result in some additional regulation. Why a company's shares could have more than 100% of them shorted is a big problem. We've seen recently in the financial news, a hedge fund blow up because of the amount of leverage that they were using, because of how they were doing it was not necessarily through it was through basically all over-the-counter sort of private transactions. And so I think there's going to be some Congress people, and rightfully so, that look at those risks and some of that volatility as a problem that can very easily be addressed to basically reduce systematic risk within the overall financial system. And so I think that's the big fallout, as well as I think a lot of DTCC, OTC is ultimately going to, I think, start looking at blockchain at some point. I know that they are, as far as settlement of securities is concerned. So I think those are really the two, big things that will come from the meme stock mania in January.
All right. No other questions have come through, so I think that's a good time to wrap it up. We appreciate you all taking the time to join. Thank you for those questions that were submitted. We hope you continue to find this helpful and informative. And again, please be sure to visit our website, meetgirard.com. Until next time, please stay safe, stay healthy, and let us know if we can help in any way. Thanks, Tim, and take care, everyone. Thanks for joining.
Thanks, Chris. Thanks, everybody.